Hey everyone, it's Alex from BizLaunch again. So you started your business, you were very successful in your business venture, and you're ready to sell. Well, congratulations. So, what impact does your entity type when you started have on when your exit strategy when you're ready to sell? Check out in our final segment of our Mason Law Clinic at BizLaunch. Take care, everybody.
There's a lot of pros and cons, as you can tell. Uh, Maybe you're sitting there wondering, why would I ever want to be a C corporation and incur that double taxation of 41%? That's not a very desirable outcome. Um, well, when you start a business, you have to decide what your objective is. And I'm going to discuss how the taxes apply to somebody whose objective is to start a business, to build it up, make it run profitably, and then sell it. And for an example, I'm going to use Mitch's landscaping service. And we've been joking with Mitch, telling him if this law business doesn't work out for him, he's always going to be able to go into the landscaping business. And it could even be more profitable. We don't know. Um, so here's sort of a snapshot of the history of Mitch's landscaping business. Uh, this is not one guy with a lawnmower. This is a big business. As you can see, he's had hundreds of thousands of dollars of revenue every year. And this is what makes a business attractive to a potential purchaser, particularly in the case of a service business that does not have a lot of inventory and fixed assets. What they're really buying when they buy a service business is the revenue stream or the customer list. So the purchase price is usually going to be calculated with reference to the collections. Here's the offer that Mitch has gotten from this big landscaping company. And this is often how these offers are calculated and communicated to you. Uh, the purchaser in this case is going to offer to buy Mitch's business for 3 times the average annual collections of the business over the last 5 years. So if you add up the last 5 years of collections, divide by 5 and multiply by 3, you see they're willing to offer to pay $674,400 to buy out his business. Most of the time, when an entrepreneur sells their business, they're going to either have to continue to work for the business or promise not to compete with it. And in this case, Mitch is going to go back to the practice of law with his $675,000 in his pocket. So the purchaser wants to make sure that he doesn't pocket the money and then go back to his former customers and try to compete with them. So they will get a promise, contractual, that says Mitch agrees not to compete by soliciting any business from any of his former customers or from anyone else in the same zip code for the next 3 years. And in exchange for promising to refrain from competition, he's going to receive an additional $50,000 per year. So when you put those two pieces together, he's getting paid almost $825,000 for the business and the non-compete. Not a bad deal. Um, Now we're going to take a look at how the tax laws apply to this kind of an offer. And when you see the different types of taxation, that will go into your analysis of the pros and cons of whether to have a pass through or an S Corp or a C Corp. Uh, you can't really comfortably assess the value of this purchase offer on this basis. You have to look at what will go into your bank account after tax. So that's the analysis that we're going to do. First of all, you may be asking the question, why would somebody pay this kind of money for landscaping business? Well, let's see what the balance sheet of the business looks like. On the left is the balance sheet of Mitch's assets. You see he's got a bank account of cash. He's got some customer accounts receivable. He's got some partially depreciated landscaping equipment. And he's got current vendor payables, and he's got some payroll taxes he collected from his employees that have to be paid over to the government. So the net assets, the assets minus liabilities, is only $460,000. Why would somebody be willing to pay $675 for $460? Well, that excess is the intangible assets that go along in a service business like this. Those intangible assets are his customer list, his intellectual property. Perhaps he's got signs and logos, and there's value to the trade name, Mitch's Landscaping Business. He could have a very good website. He could have his own top level domain name at mitches.com. And if you can't particularly identify the value of some intangible asset, then it's thrown into a category called goodwill, which is a sort of residual category of excess purchase price. And why am I even asking this question? Well, it figures into the way the transaction is going to be taxed. Now we're back looking at the balance sheet on the left-hand side. What we're doing on the right-hand side of this slide is what the buyer and seller have to agree on, not just the purchase price, but they have to agree on how that purchase price is allocated to different assets. The reason for this is that it makes a tax difference, and the IRS wants you to be consistent on both the purchaser and the seller's side of the transaction so that they don't get whipsawed, that both of you would put the best tax result on your tax return. So here, the purchase price is being allocated pretty much dollar for dollar to the identified assets on the balance sheet. It doesn't have to be, as long as the two parties agree. But in this case, cash is worth dollar for dollar. Receivables are all good, collectible. And you see that I've put the whole $214,400 of excess purchase price into the allocation in the goodwill line. I'm going to keep this next section simple and assume zero basis. For those of you who understand gains and losses, this is going to be a simplified example. Here are the different tax rates that could apply to different kinds of business. Remember that individual tax rate that you pay every year on the profits of a pass-through business could go as high as 37% under current law. But if you have it as a C corporation, current taxation is only 21%. But as Rebecca pointed out, if you have a C corporation, you pay the 21% currently, and then when you pull the profits out as a dividend, you pay another 20%. We also need to be aware of trying to get the 20% capital gain rate, which is a bargain for as much as possible of the sales proceeds. And then there's a little extra icing on the cake called the investment income, the net investment income excise tax that applies just on dividends and capital gains. So this is not simple stuff. Let's take the first example, assuming that Mitch set the business up for pass-through taxation. This was either a proprietorship, a single member LLC, or an S corp. On the left-hand side is that purchase price allocation that we just figured out. And when you sell a business that's in one of these types of entities, the IRS treats it as a sale of each individual asset to the purchaser. So here the purchaser, as you can see, is paying $214,000 for that collection of intangible assets. And that part is going to be taxed at the capital gain rates, the 20% tax rate, rather than the ordinary income rate, which for numbers this large could get up to 37% under current law. Here's how the taxes are calculated on the right-hand side. Mitch's total is divided up between capital and ordinary. Again, for the purpose of simplicity, I'm assuming zero tax basis. The capital gain is taxed at 20%. The ordinary income is taxed at 37%. Do the math, and after tax, Mitch puts $555,820 into his bank account. Not bad. Could it be better? We'll see. This is just a graphic representation of what I've been talking about. You see Mitch with his single member LLC, and what he actually sells as far as the legal documents that are drafted is the membership interest in that single member LLC, but LLCs are disregarded entities for tax purposes, so it's treated as a sale of all the assets of the business. S corporations have the same result, but they may actually look like this on the legal documents. It looks like in this case, the S corporation itself is the party to the transaction, and it's selling its assets to the buyer. The buyer pays his cash to the S corp, and the cash goes into the pocket of the shareholders.
Hunter? Yes.
Okay. Okay, but what happens if it's a C corporation instead of an S corporation? Well, again, two things are happening. Mitch is getting some of the proceeds for the sale of his stock, and he's getting other payments for the non-compete promise. And when a C corporation sells its assets and makes a distribution to its stockholders, it's going to incur that double taxation, the 21% plus the 20%. So Mitch doesn't like that result. He would rather sell his stock. And that's what we're going to try to negotiate for if we're representing Mitch in the sale. And if we're representing the buyer has its own tax reasons why it would rather buy the assets. It's a more advanced subject, but the buyer will get a stepped up basis for future depreciation if they can buy assets instead of stock. And then there's going to be the separate tax on the non-compete payments. So let's do this calculation. Here's what the tax looks like. If he can sell the stock, the entire proceeds of the sale of the stock are capital gain, taxed at 20%. The only part of this transaction that's taxed at ordinary income rates is the $50,000 a year that is paid for the non-compete covenant. Do the math. After tax, $634,000. That's a lot better than the than the 555 that we saw in the previous example. So why wouldn't everybody want to be in a C corporation when they're starting their business? Well, the answer is that double taxation that you experience when you are in the operating years. Can we do even better? Yes. Assume for a minute that Mitch is able to jump through all those hoops and get qualified small business stock, what the tax people will call Section 1202 qualified small business stock. If you qualify, you actually have zero tax on the sale of that stock. So even if your tax basis is zero and the full proceeds are 675,000, you have zero tax. You only will pay tax on the ordinary income component, which is the payment for the non-compete promise. And look at the difference. Here's the comparison of the numbers. First example, if it's a pass-through entity, either a sole proprietorship, a single member LLC, or an S corporation, Mitch's after tax was 555,000. If it were to be a C corporation and he's able to sell the stock, he would get capital gains rates and he would pocket 634,000. And the jackpot is when you can qualify for this small business stock exemption and have zero tax on the sale. And there you get 768,000 net cash. So vastly different outcomes for the exit strategy, depending on the form of business entity that you sell. When you start your business, you not only want to think about how you pay taxes during the years you're operating the business, you want to think ahead to the future and say, if I'm lucky enough to turn this business profitable, what's my exit strategy going to be? When you do have the sale of a business, there's a built-in economic tension. The buyer will always want to buy assets and the seller will always want to sell stock. And that's because of their different tax consequences. That's why the IRS requires the buyer and the seller to agree on that purchase price allocation, and they both have to sign off on it. And if they don't report it consistently in their tax returns for the year of the transaction, they'll hear from an IRS agent. If you're dealing with a transaction like the sale of a business, you have to assume that your buyer is sophisticated and they understand these tax consequences. The buyer knows that it's worth more to him to get a step up in basis for future depreciation. And another one of the important reasons why a buyer wants to buy assets rather than stock is if they buy the stock, they're going to inherit everything that's on the balance sheet of that business, including all the liabilities. If you remember, we had vendor payables and withheld payroll taxes of $50,000, but the buyer is always going to ask the question of, what is there that you didn't show me on the balance sheet? What unknown liabilities, or even worse, known but unrecorded liabilities could there be? So even though these tax consequences are all subject to, arithmetic and you can figure them out, there's these non-tax advantages and disadvantages which will go into the negotiation at the time you sell your business. Okay, so that is the substance of our presentation. And now we have question time. And we've gotten a couple of questions in the chat boxes I see.